Semiconductor chip stocks like Micron have been going so low ever since they reported earnings. Now, you might be wondering, is it because the earnings was not good? Something happened in the earnings? And in fact, the answer is no. The earnings was really great. It was a beat and raise type of earnings where they're just making more and more money. But we've come to a point now where you have semiconductor chip stocks. It's not just Micron. There's a couple other of them. You have ASML, you have SK Hynix, Samsung, where they're reporting great earnings, but the stock is not moving anywhere. In fact, it's actually a downward pressure. And in cases like this, you start to have this narrative that, hey, are these companies priced in already? Because what other explanation could there be for a company that reports amazing earnings, yet the stock still falls down? Now, in return, what other companies have been doing well? Well, you take a look at the financials right now. A lot of the banking stocks have reported earnings. They have been crushing it. You take a look at the Mag 7. They have been doing very well as well. Now, are these memory chip stocks, are they expensive? Are they a bubble that's about to burst? I honestly don't believe so. And the main reason being that their forward PE ratios are so freaking low. For example, Micron has a forward PE of around 6 or 8. That's very cheap for a company with that type of growth. You take a look at SK Hynix that has a forward earnings PE ratio of 3 or even 4. That is not expensive at all. So if this was some sort of bubble, this would be one of the cheapest bubble that I've seen in a long, long time. Now, there's this narrative that's going on in the stock market saying that this time is different. And to give you a context of what they mean by that, that this time is different, I want to bring you guys back to 2018. Because in 2018, we had a similar scenario where SK Hynix, where Samsung, where Micron were doing really, really well. Because during that time, a lot of hyperscalers were trying to buy as many memory chip stocks as they can. Until in 2018, the bubble burst. What ended up happening was that a lot of these hyperscalers, they double ordered on their chips. And these chip stocks, they were actually trading at similar 4 P ratios. They were trading around 6 or 8, like Micron was. So people didn't expect that this was going to be some sort of bubble that burst in 2018. But what ended up happening is because these tech companies, hyperscalers, they did double orders of memory chips, and these memory chips were sitting in their inventory, not really doing anything. A lot of these hyperscalers ended up halting on their orders. So even though the forward PE of many of these chip stocks were very low during 2018, because there's no new money coming in, not a lot of revenue coming in, bam, you had a big drop in memory chip stock prices. And as a result, this is what they're talking about in the stock market when you hear this time is different. Because people are saying that, hey, because of AI demand, that we're not going to have a big drop in this memory chip issue like we had in 2018. In fact, this time is different because with AI, we're going to need unlimited amounts of memory just because of how much data and how much memory storage that AI will need to utilize. Now, whether you decide that you want to invest into memory chip stocks because they're trading at such cheap levels, or you decide to sell out of them because you're reminded of 2018 era, it really is dependent on you. But one thing you got to be aware is of how volatile these companies are, because these earnings that a lot of these memory chip stocks are reporting, they are home runs essentially. They are reporting such great numbers, and there's nobody surprised about it. At this point, almost every memory chip stock is expected to have amazing earnings. And if they don't have amazing earnings, now that will be a surprise. Now, the fears that I have in the current stock market right now is something that has to do with rate hikes. And the reason why I'm believing that we're going to have higher rate hikes is because of inflation. When you take a look at the CPI report, inflation is still above 3%, a whole 1% higher than the targeted inflation that we go for 2%. Now, why am I so scared of the rate hikes? Is because when I take a look at the previous bull run killers, the reasons why a lot of bull runs have ended before is because of rate hikes. For example, you take a look at the most recent one in 2022. We had 7 rate hikes going into 2022. And as a result, you take a look at the year stock market prices, that was killer for stock market prices. That was not very good for them. And the one after that, right? You look at 2008, the year that stock market fell a ton. From 2004 to 2008, the stock market had 17 rate hikes. And afterwards, you ended up having the huge bubble collapsing the 2008, right? And then before that, you had 2001 dot-com bubble, where we had 6 rate hikes going into the dot-com bubble. And as a result, we had another catastrophe there. And this is why I have such a big fear of rate hikes, is that it is the one thing I've noticed causing a lot of competition, a lot of issues for the stock market. And it's because it's not just me and you who invests in the stock market. There are a lot of individuals out there, a lot of hedge funds, mutual funds out there that want to invest in mutual funds, that want to invest in municipal bonds, in treasury bills, things that are impacted by interest rates. And as a result, it creates more competition out there for stock market when you have the Federal Reserve increasing the rates. Now, they have to increase the rates if we have a case where inflation is just getting out of control. The Federal Reserve does have to step in and increase those rates. Now, the bad part is when they do increase those rates, from what we have seen in the last 3 times, it really does make a huge impact on the stock market, because not only just because of the increased competition in the stock market, because bond yields and treasury bills will go higher, but also because of the increased borrowing costs that a lot of these companies have to do, especially during right now where a lot of the hyperscalers have huge capital expenditures. A lot of companies out there, they have a lot of AI spending. By increasing the interest rates, it puts a big pressure on people borrowing money, companies borrowing money, and also puts a lot of pressure on the stock market because now you have more competitors. The stocks are not the only game in town. The way I currently see the memory chip stocks right now is that they are priced in, because when you have companies reporting amazing earnings and the stock is just not budging at all, and in fact, in certain cases, the stock is actually going lower, this causes incredible amount of fear for me. Fear for me as an investor that wants to potentially get into memory chip stocks, because now you have a case, you have a potential possibility where everybody who wants to get into memory chip stocks, they're already in the company. So whatever the earnings are being reported out of these companies, it seems like it's priced in, because you take a look at the stock after earning price movements and it's not budging whatsoever.